Daniel Drew was a lying, cheating, scheming, grasping individual, and those were his good points. Today, we're looking at one of the most notorious American grifters in history. A man who started out as something of a cattle rustler and wound up being one of the most famed robber barons of the Gilded Age, manipulating the stocks of America's railroads and making a fortune for himself in the process. So, who exactly was Daniel Drew? This handsome chap was born in Carmel, a small township about 50 miles north of New York City, in July 1797. He was the younger of two sons of Gilbert Drew and Catherine Muckleworth, who were relatively poor farmers with a hillside estate of close to 100 acres. Daniel's early life was one of basic subsistence, with no luxuries and a Spartan education. Things deteriorated in 1812 when, at just 15 years of age, his father died, quickly followed by a declaration of war between Canada and the United States. The family's situation became perilous, and there was a real possibility of destitution. The decision was therefore taken that Tom, as the older brother, would stay at home to run the farm, and Daniel would leave to make money as a substitute in the war. When the president issued a draft for men to fight in the war, the sons of wealthier individuals started to offer as much as $100, the equivalent of $2,400 today when we factor in inflation, for a substitute to take their place. To a poor farm boy, that $100 looked like a king's ransom, and so Daniel accepted the ticket and set out to Peekskill, in New York City, for basic training. Daniel's good luck in life would soon show itself. He was stationed to Fort Gainesville in Jersey City, where not a single shot was fired. And just 3 months later, peace was declared, and Daniel was demobbed back to the farm. However, after his brief taste of the big city, Daniel didn't fancy life as a farmer, working tirelessly just to break even, and decided to go into business for himself. While stationed in New York during the winter of 1812, Daniel noted the price the locals were willing to pay for meat and milk, and so determined to become a drover, effectively buying the cattle from the small farms in Carmel and walking them to the butchers in New York City and making a nice profit on each journey. In this first business venture, Daniel quickly showed the shrewdness, or coldness, depending on your perspective, that was evident in all of his latter dealings. Rather than buying cows for which he would have to pay a fair price to the local farmers, he instead opted to buy newborn calves, particularly those which demonstrated a sickly nature and were unlikely to survive to adulthood. Daniel was able to buy these bobville cows for next to nothing, and he wagered the city butchers of New York would fail to identify the sickly nature, which in any event wouldn't matter because they were going straight to the slaughterhouse and would still produce good quality meat. Because cows only tend to calve in the spring and autumn, it left Daniel with significant free time during the year, and so he did what any self-respecting hustler would do and joined the circus. At this point in history, way before television, let alone smartphones, people, particularly those in rural communities, had scant entertainment, and so traveling circuses were big business. They toured the countryside with acrobats, clowns, and a menagerie of wild animals to entertain the local townsfolk. Daniel was tasked, not unsurprisingly for a farm boy and cattle drover, to look after the animals, in particular the elephants and big cats. In his own autobiographical notes, Daniel, completely unashamedly, shares tales of his time on the road with the circus, where he would get free meat from the local butchers by agreeing that the clowns wouldn't defame them with bad jokes during the show, after having very strongly suggested that it was a real possibility said butcher would be the butt of the jokes. Again, early in his career, we see the completely mercenary nature of Daniel Drew, and as his success and power grew over the years, so too did his manipulations. Due to his hard work and sharp behavior, it wasn't long until Daniel was offered a partnership in the circus. After ruminating on the options available to him, Daniel decided to decline the partnership and leave the circus entirely. He concluded that, considering the massive growth in population of New York City at that time, selling meat from the surrounding countryside to the butchers of New York would be a much more lucrative line of business in the long run. In early 1817, as the economy of New York and the wider United States were recovering from the effects of the war, Daniel doubled down on his droving business in earnest. Instead of dealing purely in bobville, He now desired to be a serious player, dealing in premium meat and fully grown cows. The difficulty was that Daniel had limited reputation with the farmers, and so couldn't get credit from them, plus he had limited capital with which to buy the cattle to transport to New York. These hindrances didn't hold back Daniel too much. With his gift of the gab and his newfound religion, he'd found he could charm most farmers into trusting him with their prized cattle for the drive into New York, and to thereafter return with the farmers' share of the profit. This second point, returning to the farmers with their cash from the sale, often proved difficult for Daniel. Despite the healthy sales prices, once the money was in his hands, he really didn't like to part with it. There are stories from Putnam County years after Daniel gave up the droving business of farmers, still waiting for payment from the newly minted millionaire Daniel Drew. Daniel, in his autobiographical notes, again proudly tells of how, after earning a poor reputation with farmers in one county, he would simply move his base of operations to another, and once again charm the local farmers into entrusting him with their prized cattle on the drive to Manhattan, and to return with the money owed to them. Daniel continued to boast that the best way to earn the trust of the local farmers was to haggle as hard as possible over the price of the cattle. It seems the farmers didn't believe that a man, and a religious one at that, would haggle so hard over each head of cattle if he simply intended to defraud them. And so Daniel used this tactic time and again to take effective ownership of several hundred head of cattle, which he then took to the butchers of Manhattan. It remains unclear just how many of these cattle he eventually paid for. The only certain thing we know is that it seeded Daniel with sufficient capital to expand his business empire. One final note of Daniel's businesses as a cattle drover, again delivered as a boast by Daniel himself, and again demonstrating the type of business scruples for which he became famous, was another method he devised for maximizing his profits per head of steer. You see, when the cattle was driven to New York by the various drovers, they'd finished their ride at the Bull's Head Inn, a tavern which was surrounded by pasture land and individual paddocks, in which the drovers could safely keep their cattle until sold. For their part, the butchers of the city would ride up to the inn to negotiate sales, and then take their cattle to their slaughterhouses. The insight that Daniel had was the method of sale. The butchers always wanted the biggest heifers, which would obviously have the most meat, and because the price per cow was determined by their weight, the butchers would pay more for these because less weight was lost on bone and offal. Daniel set about maximizing his profits. He achieved this by refusing to provide his cattle any water when they were within 24 hours' walk to New York. Instead, he actively fed them salted food to maximize their thirst. It was only when they were at the Bull's Head Inn, and Daniel had word that the butchers were close, he would finally let his cattle drink. And because of their dehydration, coupled with the amount of salt consumed, they would each drink water by the gallon, artificially inflating their weight just in time for the butchers to arrive. Daniel maximized his profits per head, but ruined his relationship with the butcher he had cheated once they realized the scheme after the cows had weed away a good portion of their weight after the sale closed. And so they never did business with him again. The peculiarity is, because of the butcher's competitive streak, they would each introduce Daniel to one of their fiercest competitors the next time he drove some watered stock into New York. However, even in a city the size of New York, Daniel rather quickly ran out of butchers to cheat, and as his reputation lay in tatters, he could no longer operate as a cattle drover. His career as a drover came to a swift end, but not before adding a new term to the American lexicon. That is, watered stock. A term coined after Daniel's scam with the butchers, and that quickly followed him to Wall Street when he devised similar such schemes to scam ever greater numbers of people with watered stock in public equities. Even after Daniel became persona non grata with the butchers of New York, in search of a new business opportunity, and displaying his usual thick skin in regard to what those around him thought of his conduct, Daniel decided to buy the Bull's Head Inn and operate the very place where the drovers and the butchers met to do business. And again, Daniel's conduct became infamous. He would often double book rooms when times were busy and simply expect guests to share rooms with strangers. He would offer informal banking services, offering to hold customers' cash in his newly installed safe. And the drovers were often cash rich after selling their herd. And Daniel, by his own admission, would simply avail himself of some of these funds, deciding what he thought he was owed for board and lodgings, and only returning the remainder. He also found a side hustle by trading horses, and again gleefully bragged about how easy it was to sell broken-down nags to unsuspecting and ill-informed city folk. Unsurprisingly, his tenure as landlord of the Bull's Head was fairly short-lived. For his next venture, Daniel did the obvious thing for a farm boy turned cattle drover turned landlord and set up a steamboat company. Daniel observed the success Cornelius Vanderbilt was enjoying by operating a fleet of steamboats on the Hudson River and decided to take some of the trade for himself. When he wasn't driving cattle, Daniel would often take the steamboat between Manhattan and Peekskill, the closest stop to his home in Putnam County, and determining that it was a simple business to be in. And, as an added bonus, because of the lack of competition, the prices translated to high profits. Plus, this was a business that would operate pretty much year-round, as opposed to the seasonal cattle business. So, in 1834, at 37 years of age, Daniel Drew, in collaboration with a partner, each investing $1,000, the equivalent of $37,000 today, purchased the steamboat the Water Witch and set about operating the line between Peekskill and Manhattan, in direct competition with Cornelius Vanderbilt. Vanderbilt, not one to be trifled with, immediately slashed prices on the Peekskill line, forcing Drew to do the same. In the first year, Drew lost $10,000, equivalent to $365,000 today, on his steamboat business. Angered by Vanderbilt's actions, Drew traveled to Peekskill and started a moral crusade against Vanderbilt, telling the locals they were being cheated by high prices and a corrupt ferry service. He successfully negotiated for local businessmen to invest in his own ferry service, which made them captive customers, and enabled the Water Witch to not only turn a profit, but also give a black eye to Cornelius Vanderbilt. However, Drew being Drew, he was less interested in moral campaigns for the people of Putnam County, and more interested in his own financial success. And so, without telling his new business partners, Drew sold his shares in the Water Witch line to Cornelius Vanderbilt, with the prices on this service quickly increasing back to their old rate. When caught out by the partners he had duped, Drew simply retorted, "I didn't feel called upon to keep myself back, just in order to provide better transportation for Putnam County farmers. I had my own fortune to make, my own career to carve out. Any fellow, except he's a natural-born fool, will look out for number one first." With his new fortune from the sale of his steamboat shares, Drew set out to repeat this scheme. This time he decided to go up against the Hudson River Association, which had a monopoly on the line between Albany and Manhattan. Drew quickly repeated his formula. He purchased 2 steamboats, slashed prices, and rallied the people of Albany against the corrupt Hudson River Association, which was inflating prices and cheating the townsfolk. In less than a year, Drew and the Hudson Association reached an agreement where they would pool bookings and share total earnings between themselves, with prices quickly rising to ensure good profits for all those involved, other than the customers. No content with cheating the people of Albany, Drew then decided he also wanted to cheat his new partners in the Hudson River Association as well. He therefore devised to buy a 3rd steamboat and operate it under an assumed name, plying the trade between Albany and Manhattan at a newly discounted rate. At the directors' meetings of the Hudson River Association, Drew pushed for something to be done about this upstart, and at Drew's suggestion, the other directors agreed to buy out this new operator for $20,000, equivalent to $730,000 today. The most galling point about this episode is that the other directors voted for Drew to conduct the negotiations, which he did, negotiating against himself to sell his own boat to the Hudson Association. Emboldened by this episode, Drew decided he wanted his own monopoly on the Albany to Manhattan route, and broke free from the Hudson Association. Using the money he cheated from his former partners, Drew purchased 2 new boats, slashed fares, and set out to destroy the Hudson Association. After a race from Albany to Manhattan between Drew's new boat, the Rochester, and the Hudson's Association's the Swallow, which was soundly defeated by Drew's newer and faster vessel, coupled with the cripplingly low fares and compounded by the cash flow problems caused by Drew's scheme to cheat his former partners. The Hudson Association quickly folded and was bought out by Daniel Drew. Once he had his monopoly over all of the traffic from Albany, Drew's first course of business was to more than double the fares to $3, or $109 today, for a single trip from Albany to Manhattan. With a monopoly on the Hudson, and no railroads yet in operation, Drew had connived his way to a gusher of gold. Not content with this monopoly, Drew continued his pattern of cutting corners. He determined it wasn't time efficient to stop the boat at every small port between Albany and Manhattan to allow passengers to disembark. Instead, they were put in a rowing boat and pushed in the direction of the pier. Most of the time they made land. Sometimes they ended up in the water. However, after one disastrous journey at Poughkeepsie, where several passengers drowned, new laws were introduced to outlaw the practice. But Drew escaped without prosecution or even censure. Drew also cheated his passengers on the fares, advertising some journeys for 50 cents, then charging $1.50 when they arrived, betting that once at the pier, passengers would pay up rather than wasting the journey. Drew would also gouge his passengers in other ways. If the journey was overnight, food and bedrooms were charged an additional rate, and the rate was prohibitively expensive. But Drew knew he had a captive audience. Not content with these schemes, Drew also boasted of employing gangs of boys to stand at the docks of competing lines in order to spread rumors about the safety of the vessel they were about to board. Sometimes their tactics got out of hand, and they intentionally cut the safety ropes of a boat in dock, which subsequently drifted into the river and collided with a full passenger boat, almost killing all on board. After several years in the steamboat business, Drew noticed his old adversary, Cornelius Vanderbilt, had sold out of the business entirely and was now focusing his energies on the new railroads which were rapidly being constructed across the country. Drew, always in awe of Vanderbilt's business acumen, and well aware of a new train line being laid from Poughkeepsie to New York, which would give significant competition to his riverboats, decided he too would join the new gold rush and have his own train line. In a surprising turn of events, Drew teamed up with his old nemesis Vanderbilt to buy control of the new Boston and Sterling Railroad. Drew also set up new steamboat lines to connect the new railroads with ports in New York, thereby controlling the flow of passengers and the price they would have to pay to travel. Never one to be idle, and just prior to his partnership with Cornelius Vanderbilt on the Boston and Sterling Railroad, Drew finally gravitated toward the place all get-rich-quick hucksters go, Wall Street. At this time, Wall Street was only just emerging as a trading center, along with a rise in joint stock enterprises which were needed to finance the capital cost of establishing a railroad. As with all emerging industries, rules were lax, competition was nascent, and profits could be huge, all of which were a big draw for someone like Daniel Drew. Drew partnered with Nelson Robinson, a former circus performer, and Robert Weeks Kelly, a former drover, to found Drew, Robinson and Company. The company operated as a bank, lending money to individuals and businesses, as a brokerage, enabling third parties to buy and sell shares in public companies, and as a proprietary trader, making investments in public and public securities on their own account. It didn't take Drew long to make two big realizations about this new business. First, a person could make more in 12 months from speculating in shares than they could from 12 years of operating steamboats, and second, that Drew didn't operate well with partners, especially when they were more risk-averse and wanted to focus on the more stable, lower-risk banking business than on Drew's increasingly large stock speculations. Whilst retaining ownership of some steamboat lines, his emerging investment in the railroad sector, and the creation of his own banking house, Drew was busy. Very busy, but he was also increasingly wealthy and had stable streams of capital which he could now use to speculate in public companies. It was at this time Drew became acquainted with the New York and Lake Erie Railroad, generally known as the Erie. The railroad, which spanned 500 miles from New York to Lake Erie, was first chartered in 1832, with construction commencing in New York in 1836, and opening in sections until it finally reached Erie in 1851. The inception of the line was inauspicious, with the original investors running out of capital before the line reached the halfway point, and so being forced to sell to English investors who provided sufficient capital to complete the line. When operational, Drew considered that Erie should be a gold mine. It ran through his home county, and he knew the abundance of livestock, crops, iron workings, and natural resources would naturally gravitate toward the higher prices available in New York City. However, Daniel Drew, being a cold-hearted, scheming manipulator, wasn't satisfied with the idea of buying shares in the Erie to make a good long-term gain. He wanted to achieve maximum leverage over the line in order to achieve maximum profits. He set out his plan meticulously. Drew was already aware that the New York Central Railroad, when coupled with his own steamboats on the Hudson River, could make a fierce rival for all western traffic coming into the Erie, particularly if Drew gave the New York Central more favorable shipping rates. Additionally, Drew was aware that on the western end of the Erie line, the railway was dependent upon a single shipping line operating on Lake Erie for all traffic from the western states, and so Drew purchased a controlling interest in that business. The final part of his scheme was to purchase a controlling interest in the Buffalo and State Line Railroad, a minnow of a railway in western New York State that connected the central line to the Erie. Once he had set his trap, Drew set out to catch his prey. In a method of manipulation which would become standard practice for the rest of his career, Daniel allowed rumors to circulate around the markets that the New York Central had far preferential rates on all through traffic in New York, and that the rates the Erie would have to pay for traffic over Lake Erie were set to double, in addition to the Erie being locked out of the Buffalo and State Line, connecting the line with the western markets. Drew's plan at this point wasn't to make money from manipulating the share price. It was to become an insider of the Erie Railroad. He knew that was where the power, and ultimately the money, truly lay. Besides which, the year was now 1857, and the country was mired in a recession. Most companies were losing money, although the Erie was still performing well and paying a dividend of 8% of par value. There wasn't much of a stock to depress at this point in time. His plan worked perfectly, and Drew was quickly elected as a director of the Erie. The fox was now inside of the chicken coop. The next phase of his plan to control the railroad was to make the company indebted to him, quite literally. His banking firm, Drew, Robinson and Company, extended a loan of $1,500,000 to the Erie, secured against all rolling stock of the road. By his own gleeful admission, Drew noted, "When a man is in your debt, he is your slave. You own him, body and breeches. You are the cat, and he the mouse." With his directorship of the Erie, his control of the shipping on the Hudson and Lake Erie, his control of the Buffalo and State Line, and the Erie's indenture to him, Drew was now firmly in control of his prey, and for the next decade, he manipulated its stock for all it was worth. When the Erie decided to expand the line south to Jersey City, and so remove the need for transfer to a Hudson River boat to complete the journey, Drew wasted no time in circulating rumors around New York that the Erie was in serious trouble. He let it be known that tunneling under Burden Hill wasn't going to plan, and was consuming vast sums of money, that the legislature in Albany were unhappy that the terminus was to be moved to Jersey City, which could result in a recall of public grants, and that the construction of a new station and pier could bankrupt the railroad in its entirety. Drew's machinations had the desired effect, and the shares of the Erie fell from $63 to just $33, a decline of 48%. You may question why Drew wanted the shares to fall, and the man himself, again in a braggadocious manner, covered this episode in his own autobiographical notes. Drew noted that in order to maximize his trading profits, he would short-sell shares in the Erie. Then, as a trusted insider, he would circulate rumors about the parlous state of the railroad in order to depress the price, at which point he would profit. Sometimes, if the shares didn't fall enough for Drew's liking, he would go even further. He initiated legal proceedings against the Erie, seeking an injunction to prevent the road paying any dividends until his debts to the Erie had been repaid. For the uninitiated, a short sale involved Drew borrowing the shares from someone else, selling the borrowed shares at the market price. Then, at a future date, Drew would have to return the borrowed shares. which would mean buying them back at the market price. If that market price was lower than the price at which Drew sold, he would make a profit, and if the market price was far below the price he sold, his profits would be ever larger. The same was also true in reverse. Drew would often buy shares in the Erie on margin, meaning he borrowed the money required to buy the shares. Then he would circulate rumors the railroad was doing great and dividends were likely to increase, resulting in the share price rising, at which point he sold out for a profit. Today, either of these actions would be considered stock manipulation and insider trading, and would result in Drew being sentenced to imprisonment and forfeiture of his profits. However, in the 1800s such rules didn't exist, and the robber barons like Drew were free to operate unimpeded by the law. And Drew really enjoyed manipulating the stock of the Erie, so much so that it became an almost full-time job for him. It's not hard to understand why. Drew could often clear a profit of $25 per share, and given his increasing capital, he was trading 20,000 shares at a time. This resulted in a profit of $500,000. A huge sum of money, equivalent to $19,300,000 today. Drew's machinations continued along happily until 1861, at which time he found an even better way of making huge sums of money as fast as possible: the Civil War. Drew later confessed that he never had 4 other years which were as prosperous for him as those of the Civil War. In addition to carrying more freight over the Erie and his shipping lines, Drew also grew accustomed to speculating in the shares of other companies. Ordinarily, he would avoid this. He noted that without inside information, of the sort he had with the Erie, speculating was simply a dangerous gamble. However, Drew didn't leave his speculations to chance. He simply started bribing congressmen, politicians, and generals in order to get news of the military campaigns before anyone else on Wall Street. Again, a method of investing that would be completely illegal today, and frankly, was largely illegal then. But Drew continued unabated and multiplied his fortune 7-fold. Emboldened by his successful manipulations of the Erie and his war profiteering, Drew decided that he was now a master of the universe, or a money king as they called them in the 1800s, and could control any situation to his advantage, a level of bravado which almost caused his bankruptcy. The Harlem Railroad, a line controlled by his old friend cum nemesis Cornelius Vanderbilt, had a provision in its original charter that allowed the line to extend from Harlem, in the north of Manhattan, all the way down to Battery Park, at the southern point of Manhattan, providing it with a near monopoly on rail traffic through the island. This charter was old and largely forgotten. In fact, the Harlem line was largely unwanted by investors. When Vanderbilt commenced buying its stock in 1860, it was trading at just $8 per share, and when it became public Vanderbilt was buying, he was mocked as an out-of-touch old man. That is, he was mocked by everyone other than Drew, who promptly followed him into the Harlem, and quickly became its second largest shareholder, even though he didn't know Vanderbilt's plan at that time. When Vanderbilt applied to the mayor for permission to expand the line, consent was quickly granted, and the price of Harlem stock skyrocketed. However, not content with the huge profit he turned on his shares, Drew decided he wanted more and set in action a scheme of events that crippled him. The Harlem stock, bought at $8, was now trading for $75 per share. Drew decided that he could manipulate a squeeze on the stock, and so, in typical form, he started to short the stock. And because of his newfound bravado, he short-sold a huge amount to the Harlem. However, Drew didn't think there was any risk with this trade because he had successfully corrupted the councilmen of New York, including the famous Bill Tweed, or Boss Tweedy as he was known, all of whom had followed Drew into this short position. When they had finished short-selling the stock, the New York councilmen, at the behest of Drew, revoked the consent to extend the Harlem. As expected, stock in the Harlem began to fall precipitously. Drew's expectation was that it would fall to $50, at which point he could sell out for another huge profit. However, on this occasion, Drew had underestimated his adversary. Vanderbilt first began buying Harlem stock in the open market, propping up its price, and then he sued the New York Council, with the court quickly dissolving the revoked consent. When it became apparent to other investors what was happening, it leaped into the Harlem. Its stock recovered and soared up to $185. This was bad news for Drew and his co-conspirators, who would now have to pay ever more to buy shares in the Harlem to close out their positions. But then things got worse, much, much worse for Drew. It transpired that Drew and his group had short-sold more stock in the Harlem than the free float that was available on the market. They were now in a bare squeeze, where irrespective of the price they offered, there was simply not enough shares available in the Harlem for them to buy and close out their positions. The price continued to rise all the way to $285. What should have been a huge profit for Drew, buying at $8 and selling at $75, now threatened his solvency, and Vanderbilt, the controlling shareholder of the Harlem, and the only man who would forgive Drew his debt, wasn't in a forgiving mood. After all, it was Drew who tried to stop Vanderbilt expanding his line, just so he could manipulate the stock. After stewing on the position for a few days, and like a latter-day Trump threatening to repudiate the contract and refuse to pay up, Drew then went back to Vanderbilt and threatened to sue him over the dispute, and given the number of corrupt judges on Drew's payroll, he could drag out the case for a year, or if Vanderbilt was amenable, they could settle on a figure there, and then for Drew to buy himself out of the short position. The two men agreed on a settlement of $500,000, equivalent to $19,300,000 today, which effectively wiped out the profits Drew had made from manipulating the stock of the Erie, but he was still solvent. Never one to be down and out for long, Drew quickly stumbled on a tremendous money-making opportunity. This one differed slightly from his recent escapades in that involved manipulating a person rather than a stock. David Parker, generally known as California Parker, was from a wealthy family of gold miners in California and had traveled to New York to try and increase his own fortune and prove himself to his family back west. Unfortunately for California Parker, Drew had other ideas for the young man's money. Drew and Parker came to an agreement to manipulate the stock of the Erie. The basic plan was for Parker to buy as much stock in the Erie as possible, using margin to maximize the size of this position. And when he was running out of capital, Drew would then support the price. The plan was to draw in investors and create a bull run in the shares, at which point Drew and Parker could sell out for a tidy profit. At least, that's what California Parker believed to be the plan. Drew had other ideas. As the largest holder of shares in the Erie, Drew was happy for the price to be pumped up. And as Parker got to work, shares in the Erie steadily rose from $100 to $123. However, and completely unbeknown to Parker, it was Drew who was selling all the shares that Parker was buying. At prices ranging between $110 and $120, Drew sold all that he could onto the young, unsuspecting Westerner. Parker quickly expended $2 million on shares in the Erie, $300,000 of his own money, and $1,700,000 on margin. When the upstart's capital was exhausted, he went to Drew to let him know it was his time to begin buying. It was at this point Drew coldly informed California Parker that he wouldn't do any such thing. With no more buying, the shares began to fall. Parker received margin calls which he couldn't meet, and so, as his brokers liquidated his position to pay his debt, the shares in the Erie tumbled from $123 down to $99. In just 4 days of foolishness, California Parker had gambled away the family fortune which it had taken 2 generations to build. And Drew simply bought back the shares he had sold at the new lower price, locking in all the gains which Parker had lost. As wild as Drew's life had been so far, from cheating farmers and butchers to fleecing his partners in the steamship business, to manipulating the Erie and skinning unsuspecting greenhorns from out west, it all turned out to be a very timid warm-up for what was about to come. Over the next few years, a series of deals unfolded which made Daniel Drew a household name and cemented his place as one of the century's preeminent robber barons. This chapter of Drew's life began innocently enough with an introduction to James Fisk. James, or Jim Fisk, was a peddler of general merchandise from the mountains of Vermont and an assistant in Amberg's menagerie, the same circus with which Drew had traveled in his earlier years. He graduated to selling dry goods on behalf of Jordan, Marsh, and Company of Boston, where he did an incredible amount of business, primarily by cheating the government during the Civil War. When news of his exploits reached the partners of Jordan and Marsh, Fisk was asked to leave and given a $60,000 leaving bonus, the equivalent of $2,200,000 in 2025, and which demonstrates how much business he generated the firm during the war period. With his leaving bonus, Fisk did what every get-rich-quick huckster did and headed straight for Wall Street, where he set up himself as an investor and broker. It was in this latter capacity that in early 1863, when Drew was 66 and Fisk 28, he came to Drew touting for business. It transpired Fisk was aware of a group of investors in Boston who desired to own Drew's interest in the Stonington Railroad, the first investment Drew had made in railroads alongside Cornelius Vanderbilt, and they were prepared to pay a pretty price for it. Drew trusted the young Fisk, and the transaction was executed without a hitch, putting in motion the start of a business relationship that would indelibly change both of their lives. As their relationship blossomed, Fisk started to execute most of the important trades for Drew, especially his manipulations of the Erie Railroad. Drew was once again getting rich from these manipulations, and Fisk, riding his mentor's coattails, was also becoming a very wealthy man. However, as rich as Drew was becoming from his manipulations of the Erie, other investors were increasingly agitated by the volatile share price and the seeming lack of focus on the core business of operating a railroad, rather than Drew and some other directors solely focusing on stock manipulations. After a decade of his involvement in the line, his old frenemy, Cornelius Vanderbilt, came forward declaring that he was going to oust Drew and his cabal of gamblers from the Erie once and for all. This declaration came shortly after another Drew manipulation. The Erie was in need of $3 million in order to upgrade the line, and Drew offered to make the loan. Its terms were to have bonds which had first call over the Erie's assets, that the bonds should be convertible into 30,000 common shares, and an additional 28,000 Erie shares, which were authorized but unissued. The terms of this transaction were kept private. And so, armed with an additional 58,000 shares in the Erie, and the knowledge that had been withheld from Wall Street, Drew started to short-sell the shares of the Erie in huge numbers. When he started selling, the shares were $95, and after a month of heavy selling, the shares were still $95. This was primarily because the country was experiencing a boom, and all stocks were rising. Word quickly spread around Wall Street that Drew had made a fundamental error and had caught himself in a bear trap. As the voices mocking Drew grew ever louder, he simply took the 58,000 supposedly unissued shares and dumped them on the open market. The Erie shares plunged from $95 to $47 within hours. Drew was then able to buy back the 58,000 shares for the lower price and profit $2,800,000 on the trade, the equivalent of $57 million today. Drew later acknowledged that the 58,000 shares had simply been entrusted to him as collateral until his loan was repaid, but was quoted as saying, "You can't stop for every little technicality on a business deal." Investors, as well as the wider public, were outraged, and so Cornelius Vanderbilt stepped forward to wrest control of the Erie from Drew, an episode which later became known as the Erie Wars. Vanderbilt gave his brokers orders to buy all the Erie they could on the open market. Then he partnered with other large holders who were also disgusted with the way the road was being run. They quickly secured enough shares to have effective control of the line, certainly enough to be able to remove Drew as a director at the next meeting. But then came Vanderbilt's first misstep. Drew approached his old friend, promised he would make no more manipulations of the stock, and that he would help Vanderbilt remove the other directors, who were all corrupt, if only Drew would be allowed to remain as director. Vanderbilt, swayed by the argument and sentimental enough to believe Drew, agreed to the deal, at which point Drew immediately set out to block Vanderbilt's takeover of the road. Drew was no fool and immediately recognized that going up against Vanderbilt and his consortium alone would be a fool's errand. He quickly secured the fealty of Jim Fisk, plus a new acquaintance, Jay Gould, another man whose name would go down in history as one of the all-time great robber barons. In later years, Drew was known to boast that he was already a rich, middle-aged stock speculator by the time Jay Gould and Jim Fisk were born, and that he became their Wall Street parent, teaching them everything they knew about speculations, manipulations, and cornering markets. But at this time, he needed them to survive the encounter with Vanderbilt. Jay Gould, another country boy, started out in the tanning business before heading to Wall Street and began speculating in railroads, which were the high-tech stocks of the time. Gould's favorite railroad stock to manipulate was the Erie, which was always the most volatile, and where he had managed to secure himself a directorship. The trio of Drew, Fisk, and Gould now set about taking complete control of the Erie and denying Vanderbilt his prize. Their first move was straight out of Drew's playbook. Using his role as director, he petitioned the road to upgrade the existing iron rails the road used to steel ones, which were more durable. Additionally, he wanted a third rail laid on the tracks, because the Erie was a wide-gauge line, as opposed to the standard narrow gauge, which prevented trains from other railroads using the Erie line. In order to achieve these improvements, the Erie would have to need capital, and Drew insisted on an issue of $10 million of convertible bonds, and of course, his reasons were entirely self-serving. A provision in the Erie Charter forbid the road from issuing stock below par, and the shares were currently trading around $60, meaning no one would pay $100 for new shares. But there was no mention of bonds convertible into stock. The bonds were approved and Drew held on to them, mainly because they could be converted into 100,000 shares of Erie stock. The fact that they weren't his legal property was merely a technicality and a minor inconvenience. As chair of the executive committee, Drew managed to execute this wrangle by simply turning around the existing iron rails, the worn inside edges now on the outside, and the fresher outside edges on the inside. This hustle saved expenditure of the $10 million and enabled Drew to keep hold of the bonds. Despite the safety implications of this action, Drew was a happy man. Vanderbilt, still laboring under the impression that he and Drew were on the same side of the fight, was buying as many shares in the Erie as he could so as to take complete control of the line. And Drew, for his part, was creating something of a market for Vanderbilt by short-selling shares of the Erie in massive amounts. Those aware of Drew's short sales thought he would again catch himself in a bear trap against Vanderbilt in the same way he did on the Harlem line, and eagerly cautioned him against it. It didn't take long for Vanderbilt to become aware of Drew's actions and realize he had been taken for a sucker. He quickly sued Drew and won a Supreme Court ruling which forbade the Erie from issuing any new stock. However, Drew, never one to be cowed, and always in possession of a corrupt judge or two, had a judge in Binghamton, way out in the countryside of New York State, but with just as much authority as a New York City judge, issue a new verdict which effectively ordered the Erie to issue more new stock. When Vanderbilt had secured his ruling, and unaware of the Binghamton judge, he continued buying shares in the open market, confident that Drew wouldn't be able to issue new shares, cratering the stock price. Drew, in full knowledge of the facts, continued short-selling shares in the Erie in unlimited numbers. After 2 months of this pantomime, shares which Drew had sold short matured, and he had to deliver the actual shares or face bankruptcy. And so Drew, supported by Fisk and Gould, went to the printers and had the 100,000 Erie shares, authorized by the bond issue, printed into legitimate shares of the Erie. It was Drew's plan that Vanderbilt simply wouldn't be able to support the weight of all the new shares, which he was buying on margin, and that it was Vanderbilt himself who would end up bankrupt, at which point the shares in the Erie, as well as all of Vanderbilt's other holdings, would collapse in price, and so Drew, Fisk, and Gould would make a fortune from their short positions, regain control of the Erie, and also, as a bonus, seize control of Vanderbilt's other assets. To note, it wasn't Drew's plan to deliver these 100,000 new shares to Vanderbilt. That would be a foolish move that would simply make Vanderbilt the largest shareholder of the Erie and give him complete control to remove Drew, Fisk, and Gould. Rather, Drew intended to dump the 100,000 shares on the open market crippling Vanderbilt's ability to buy them, and collapsed the share price. Then, Drew, Fisk, and Gould would buy all available shares, first to cover their short positions, then to buy the remaining shares at depressed prices in order to cement their own control of the line. The next morning, with 50,000 shares at their main broker, and the other 50,000 parceled out to 5 sub-brokers, the market opened to howls. The sub-brokers, during the morning call, started offering Erie stock in blocks of 1,000 shares. Vanderbilt's brokers quickly purchased the first 3,000 shares offered, but then smelled a rat. However, at the behest of Vanderbilt, the brokers continued to buy all available shares. These sub-brokers continued to offer blocks of Erie shares until their entire allocation of 50,000 shares had been purchased by Vanderbilt. This meant Vanderbilt was now on the line to pay $4 million, the equivalent of almost $82 million today. Then Drew and his gang pulled at their masterstroke. They immediately delivered the share certificates to Vanderbilt's brokers. And it was immediately clear that these crisp, fresh certificates were newly printed despite Vanderbilt's injunction. Some members of the Vanderbilt group deserted him and sold their shares in the Erie, reasoning that Drew could now print any number of new shares for just a couple of cents each and then sell them for the market price of $83. The price of Erie shares started to slide, at which point Drew's broker dumped the remaining 50,000 shares, sending the price careering down to $71 per share. Still, by the end of the trading day, Drew, Fisk, and Gould had taken $7 million from Vanderbilt's pockets and put it in their own. However, Vanderbilt wasn't the sort to roll over when a fight was on, and as Drew, Fisk, and Gould were celebrating their win on the day, they received note that Vanderbilt's judge had issued a warrant for contempt of court. The trio, realizing the gravity of the situation they had brought upon themselves, fled across the river to New Jersey, taking with them Vanderbilt's money, the Erie transfer books, and other official documents of the Erie which they didn't want to fall into the hands of Vanderbilt. What Drew had considered a simple plan, saddling Vanderbilt with 100,000 new shares, crushing the price of the Erie, and bankrupting his nemesis, resulting in the rest of his holdings crushing, effectively causing the largest crash in Wall Street history, had backfired. Vanderbilt was still solvent and still buying Erie's shares. The market had fallen somewhat, but not collapsed, and Drew was now on the run in New Jersey. In his own words, Drew bemoaned, "I began to see that it is poor policy for big men in Wall Street to fight each other. When I am fighting a money king, even my victories are dangersome. I had scooped a fine profit out of this Erie deal, and it was for the most part in solid cash. But, and here was the trouble, it had all come out of one man, Vanderbilt. Naturally, it had left him very sore, and being so powerful, he was able to fight back. If I had taken these profits from outsiders, it would in the aggregate have amounted to the same sum. But the losers would have been scattered all over the whole country, and so wouldn't have been able to get together and hit back. This lesson came late in Drew's life. He was now rapidly approaching 70 years of age, was on the run in New Jersey, and was no longer able to manipulate the Erie because he was cut off from New York, and also because no investor had any trust in him or the railroad. In addition to these problems, the trio of Drew, Fisk, and Gould were also starting to fight. After only a month in New Jersey, tempers were fraying. Fisk and Gould were smart enough not to trust Drew. However, it was still Drew who held the full $4 million in cash and $3 million in notes they had taken from Vanderbilt in his hotel safe. Fisk and Gould therefore had Drew followed wherever he went to ensure he couldn't communicate with Vanderbilt without them. And they say there is no honor among thieves. The trio desperately tried to extricate themselves from this situation. They tried bribing the politicians in Albany, which was expensive and had limited effect. They then tried to punish Vanderbilt by cutting freight rates on the Erie in sections where it competed with Vanderbilt's New York Central, which only caused a cash crunch at both railroads. The situation was desperate on both sides, but it was Vanderbilt who blinked first. He was able to smuggle a note to Drew, asking to meet him in New York that Sunday, a day when Drew was safe from process servers. Drew was amenable and trying to keep the meeting secret. The ruse was sprung by Fisk and Gould. Drew, ever the hustler, invited his two partners, but sent them to the Fifth Avenue Hotel whilst he made his way to the actual meeting at Judge Pierrepont's house. Unfortunately for Drew, who was still being followed by Fisk and Gould's agent, they were informed of his double cross and attended the actual meeting. The outcome of the meeting was Vanderbilt would be fully reimbursed for the new shares he had bought. Bizarrely, from the Erie's own treasury, Drew would be able to keep the majority of the money they held, and which had been taken from Vanderbilt, with Fisk and Gould having to make do with their profits on their own short sales, which were far less than the millions Drew was to walk away with. However, Fisk and Gould did demand one concession, which Vanderbilt readily agreed to. That was, Drew should be immediately and permanently removed as a director of the Erie. Everyone in the room, with the exception of Drew, agreed, but the deal was passed, 3 votes to 1. Vanderbilt got his money back. Drew got to keep his ill-gotten gains. Fisk and Gould kept their positions with the Erie, and all criminal charges were dropped. Drew promptly tried to make the best of the situation. He bragged that he had gotten one over Vanderbilt, and that the Erie was not a prize worth having now, that its treasury had been looted of about $10 million. Despite having a huge haul of ready cash, Drew was now an outsider on Wall Street. Shortly after this settlement, another connected event happened, which again indelibly tarnished Drew's reputation. A train on the Erie line jumped the rail and careered 80 feet down the hillside, killing 22 people. The reason for the derailment was that the tracks, which Drew himself ordered to be rotated rather than replaced so that he could keep the money, had worn straight through. By the year 1868, Drew was 71 years old and had a net worth of $13 million, equivalent to almost $300 million today. He retained control of the People's Line of steamboats, had some stock market investments, and a significant cash pile. But more than anything, the old man was bored and restless. After several months of watching Fisk and Gould make significant sums of money from their involvement in the Erie, Drew determined that he had gotten the short end of the stick. He now wanted back into the Erie. Drew made a point of regularly visiting the offices of the Erie to see Fisk and Gould, and despite the way he had cheated them out of their share of the Erie war profits, he believed they wouldn't hold a grudge against him. Drew's belief was always that profit beat everything else. By and by, the trio formed a new bear plan, one that would dwarf their previous machinations in the Erie, and that would affect the entire economy of the USA. Despite their previous learnings from the Erie War, their need to flee to New Jersey to escape prosecution, and the opprobrium that was heaped upon them, not one of the three saw any problem with their new plan. They simply saw the potential for profit. Their new plan was to lock up the supply of greenbacks in the whole United States and short the entire stock market. For the uninitiated, greenbacks aren't the currency we know today. In the 1800s, the USA was still the gold standard. However, in order to finance the Civil War, the government issued paper currency, written in green ink, which were specifically not backed by gold or silver. The government made these greenbacks legal tender, which, because of the massive increase in currency, caused inflation in the United States. However, after the war, and because the greenbacks weren't backed by gold, they were valued at a discount to notes backed by gold. An entire trade opened up on the New York Stock Exchange, where the gold room traders speculated on the spread between gold and greenbacks. After the Civil War ended, greenbacks remained in circulation. It wasn't until 1875 that the United States began redeeming greenbacks for gold, effectively returning the country to the gold standard. On the face of it, this seemed like an odd plan. It was autumn time. There had been a bumper crop, with ready export opportunities, and an economy which was rapidly growing, and the government had an easy money policy, which was also pumping the stock market. However, the trio's plan was that, because of the easy money policy, which had resulted in many ordinary Americans buying stock on margin for the first time, effectively borrowing up to 90% of the value of the stock, that the markets were overvalued, that there was too much debt, and that, eventually, the party would come to an end. The one factor outside of their control was timing. A stock market bubble could last for an inordinate amount of time and frustrate their plans to make money quickly. However, ever the hustlers, they determined that if they managed to lock up enough greenbacks, effectively reducing the money supply, and acting like their own central bank, they could cause a spike in the cost of borrowing, resulting in sell-offs, liquidations, and general panic. This would ultimately crash the market and enable them to cover their short positions at much reduced prices. And to remember, this plan was a full century before the United States had a central bank, which didn't come around until the Federal Reserve System Act of 1913. At the time of their plan, the government had already started retiring greenbacks. Whenever these notes were used to pay the government for taxes, etc., the notes never again left their vaults, causing a small contraction in the supply of money, but not nearly enough to satisfy the three bears. Drew, Fisk, and Gould therefore set out to expedite the expected crash. They pooled $14 million, the equivalent of $330 million today, of which Drew contributed $4 million, with $10 million from Fisk and Gould, which demonstrates just how quickly the two younger men's fortunes had improved. At this point in history, banks were legally required to retain 25% of all deposits in cash in order to satisfy any withdrawal requests. Any cash in excess of this 25% was loaded out for mortgages, business loans, and in New York to provide margin loans for stockbrokers, which was generally the more profitable and shorter maturity option. When the bank's reserves started to approach the 25% limit, they would first increase the rate of interest at which they would lend money. Thereafter, if they were still close to the 25% limit, they would start to recall their loans. With this knowledge, the trio determined their course of action. They would deposit the full $14 million with New York City banks, then draw certified checks against the deposits, meaning the banks would need to hold enough cash in reserve to satisfy the certified checks. Then the trio would use the certified checks as collateral to borrow greenbacks, which they would immediately withdraw from circulation. Before the withdrawal of the greenbacks, the three bears would sell short a broad index of stocks on the exchange in anticipation of the pending crash. When the short positions were coming close to maturity, the trio played their trump card. They went to the banks, holding the full value of their money, and demanded their immediate withdrawal. Their bankers tried to negotiate for a delay of a few days so that they could make the necessary arrangements and ensure they remained solvent and avoided financial hardship for other customers of the bank. However, the trio were unmovable and demanded the immediate release of their funds. The first step of each banker was to call on the other banks of New York for temporary loans to cover the withdrawal. However, because the trio had scattered the funds around several banks, they soon discovered that all banks of New York were in the same position and were short of funds and in need of loans. Because of the way the trio had worked their scheme, depositing $14 million and then having certified checks issued which were used as collateral, the actual demand on the various banks of New York was actually $56 million or $1.3 billion today, a spectacular sum to come up with in one day and in a time before the Federal Reserve existed. The banks went into an immediate panic. They were now technically insolvent, and so they immediately demanded the repayment of loans, initially those made to brokers on the stock exchange, which would be more easily transferred into cash. However, the brokers, who were in the business of selling stocks on a 10% deposit whilst carrying 90% of the cost in debt, were far short of the capital demanded by the banks. They initially offered to increase the interest they paid from 6% to 10% to appease the banks, but were quickly informed that their money market rate had spiked to 160%, a ruinous amount for anyone. The brokers and their customers, unable to pay the margin requirement or the interest cost, immediately put their stocks up for sale, hoping to beat the rush to sell. However, as with all panics throughout time, the sell orders reached a frenzy and prices promptly collapsed. Not only was there a rush to sell, but, without the margin accounts, there was no one willing to buy. The prices sagged ever lower, uncovering many stop-loss trades, which accentuated the push to sell and the depression of prices. The scheme conceived by Drew, Fisk, and Gould had worked just as they envisioned, but just like opening Pandora's box, there were unforeseen and unwanted consequences. The money market rate, which spiked to 160%, caused problems for ordinary business operations for companies nationwide, resulting in the bankruptcies of otherwise healthy companies. Farmers, who were expecting money from the sale of their crops, found there was no money flowing out of New York, which meant they were unable to begin planting for the new season, and in some cases were unable to meet their own mortgage payments, which resulted in foreclosure. Drew's earlier apparition of taking a small amount from many disparate people, rather than one single wealthy individual, was almost realized. The problem was, they had taken altogether too much from too many and caused a national scandal. The opprobrium heaped upon the three men quickly grew to a crescendo of vitriol. Drew, now scared for his own safety, once again betrayed his two partners and released the money he had been knocking up. However, Drew was still the main target of abuse, after years of bear raids and his previous brag that he was the one who taught Fisk and Gould everything they knew. It was Drew who drew the ire of an entire nation. To add insult to injury, even though the trio initially took almost $15 million in profit from this scheme, equivalent to $350 million today, they lost a not insignificant portion of it in the wider economic collapse that followed. But worse was to come. Shortly after Drew had once again turned on his partners and closed out his position, the Treasury Secretary had released $4 million in greenbacks to ease up the money supply. Fisk and Gould, now operating as a duo, decided, even at this point in time, it wasn't smart to fight the Fed, and so they turned to the long side of the trade. That is, they closed out their short positions and started to buy as much stock as they could, particularly in the Erie. Drew, who was now truly on the outside, was unaware of the change in plans and began to sell short the Erie on his own account. Determining that he could still profit from the work being done by Fisk and Gould without having the shares as profits by three, and without being attached to the scheme in the press. Drew found no shortage of buyers for his short sales and quickly found himself short of 70,000 shares in the Erie. Unsurprisingly, Fisk and Gould were the buyers of this block of stock, and much more besides. In fact, the duo had bought the entire floating supply of Erie shares. The 70,000 shares which Drew had short sold had a maturity of just 2 months, and as the time approached for him to make good on the transaction, the price of the Erie hadn't declined at all. Drew, still not suspicious of his former partners, tried to buy some Erie shares to limit his position, but even a small purchase pushed up the price from $35 to $47 per share, a 35% jump on a tiny trade. It was at the point that Drew started to become alarmed. However, Drew quickly discovered it was his former partners who were on the long side of the trade, and immediately went to Fisk to ask for forgiveness on the trade. Drew pleaded that they were old friends, that Fisk was already rich enough, and that having to pay would bankrupt him. But Fisk, still hurting from being cheated by Drew twice before, and being well aware of the old man's fondness of bankrupting others throughout the years, gave absolutely no sympathy to his former mentor and friend. Drew was now out in the cold. His only comrades were other short sellers who were being squeezed by Fisk and Gould. Their only hope was to sue the duo in order to get an injunction, preventing them demanding delivery of the shares sold short, if even only for a week, at which point a steamer was due to arrive from England with a large consignment of Erie stock, which English investors wanted to sell. An interesting point of the Erie was that 700,000 of the total 700, and 80,000 shares outstanding, were actually held abroad in Europe, mainly in England. However, Drew even managed to scuttle this plan by appealing to Fisk and Gould for forgiveness of his debt. In exchange, he told the pair all about the planned injunction. However, Fisk and Gould were immovable. They refused to let off Drew, and they then used his information to take out an injunction on the group before they could do the same. Drew had now checkmated himself. The group of bears who were in the same predicament now cast him out of the group, and Fisk and Gould refused to speak with him. Drew's final gasp was to try blackmailing his former partners, reporting their involvement in the Greenback lockup. However, in doing so he squealed on himself too. This plan also failed, with no action taken against Fisk or Gould, and Drew still in their debt. Returning to the stock exchange, Drew, along with the other bears caught in the trap, quickly bid up Erie shares from $35 to $62. But even at that price, no one was selling. Unsurprising considering it was Fisk and Gould who held the floating supply. However, and as unexpected to Fisk and Gould as it was to Drew, a not insignificant number of small shareholders in the Erie now appeared. They had purchased shares years ago and simply locked them away, but at this new high price, they were happy to sell and be rid of their holdings in the volatile Erie. By nickel and diming, Drew managed to cover his short position, and despite losing almost $1 million in the process, he was still solvent, for now at least. This was now the second time Drew had been caught in a serious bear trap. The first was when Cornelius Vanderbilt trapped him in the Harlem line. On both occasions, Drew lost a king's ransom, more than $45 million in today's money, but he survived to fight another day. Fisk, however, wasn't so fortunate. Just weeks after this episode with Drew, Fisk was shot dead by one of his lover's boyfriends. At this point, it was Gould who took sole charge of the Erie, and much like Drew, he appeared to be lonely without the hyperkinetic energy of James Fisk. So lonely was Gould that he approached Drew with a new investment opportunity. The two of them would work together to push up the share price of the Erie, taking a profit on the long and then on a subsequent short position. So excited was Drew at the thought of becoming an insider once again. He never stopped to consider it odd that the man, who just a couple of months ago had tried to bankrupt him, was now offering a new partnership. Drew promptly set out buying as much of the floating supply of the Erie as he could. This was an easy task at first, but after a few days a lot of shares came onto the market. What Drew didn't know was that he was buying all these shares from Gould himself. Before Drew could become suspicious, Gould approached him and said he assumed Wall Street traders had cottoned onto their plan, pushing up the price and causing so many shares to come to market. Gould, in as innocent a manner as he could, suggested that he and Drew throw Wall Street a blind by starting a side play in the Northwestern line. Gould argued that Northwestern, which had risen considerably over the preceding months, would be a great target for a short sale. Drew, entirely reliant on Gould, and not showing the intelligence of his earlier manipulations, when he previously noted that without inside information, speculating was simply a dangerous gamble, sent orders to his brokers. They were quickly able to short 20,000 shares at $75. And of course, the buyer of those short positions was Gould himself. Before the end of the week, with Drew expecting the share price to tumble, Northwestern jumped from $75 to $105, giving him a paper loss of $600,000. In his younger days, Drew lived by the adage that you cut short your losses and let your profits run. But here and now, Drew did nothing. He held his position and watched the share price on the ticker. The following week, when Drew became aware of Gould's treachery, the shares jumped to $230, leaving Drew with a loss of $3,100,000, the equivalent of $82 million today. Still reeling from this deception, Drew was quickly hit with others. First, his own grandchildren sued him. Drew had been made executor and trustee of his son-in-law's will. However, rather than investing the money as directed by the terms of the will, he used it in his Wall Street speculations. The judge ruled against Drew, and he was removed as trustee. Second, the Erie Railroad, headed by Gould, sued Drew for the 100,000 shares he had falsely appropriated 4 years earlier. The railroad demanded Drew forfeit 100,000 shares, otherwise they would take him to court for them. Finally, in 1873, a financial panic ensued due to the overexpansion of railroads financed by borrowed money, and with a lack of demand to cover the cost of operating many lines. Bonds were defaulted and bankruptcies snowballed. In September 1873, the respected firm of Jay Gould and Company collapsed, resulting in a Wall Street crash, so severe the exchange was closed for 10 days. Over the course of the next several months, dozens of banks and hundreds of businesses collapsed, resulting in a spike in unemployment to over 1 million and a collapse in wage rates. The effect of this on Drew was devastating. Still reeling from his losses at the hands of Fisk and then Gould, Drew was now missing the dividends on his holdings, which had been cut off because of collapse in profits of the companies, some of which actually failed, including his investment in the brokerage house of Kenyon, Cox and Company, the brokerage which had handled all of his trading business. Plus, there was still the question of the 100,000 Erie shares which he may have to return to the railroad at a cost in excess of $6 million. Drew was now cornered, and he was desperate. In his desperation, he decided to mix an old and new strategy. First, he sold huge amounts of call options at the Wabash Railroad, betting the price would fall. Second, he tried to corner the gold market, remembering that when he, Fisk, and Gould cornered the money market before, margin rate increased and stocks declined. Drew was new to options, as were most in the United States. They had only started trading over the counter in 1870 and were seldom used, but he really liked the leverage you could get from them, each contract representing 100 shares of the underlying company. The problem for Drew was that leverage also works in reverse. At the same time Drew was executing this trade, the market was recovering, gold prices were tumbling and share prices were rising. Drew lost what remained of his fortune in his gold trade, and when the owners of the call options came to collect, Drew simply couldn't pay them. He had learned in earlier years that it was safer to take a small amount of money from hundreds of individuals scattered across the country, rather than to take the same amount from one money king. But now it was he himself, the money king of Wall Street, who was in debt to hundreds of people across the country. And he simply had nothing left with which to pay. Daniel Drew, at the ripe old age of 82, was declared bankrupt. The money king, who was once worth more than $1/3 billion in today's money, had lost it all on faulty speculations. He lived out the rest of his life at a boarding house in New York, and there wasn't too much life left. Daniel Drew died on the 18th of September 1879, aged 82 years, and the total value of his estate was the clothes in which he was buried. One of the most remarkable points in the life of Daniel Drew is that he never once thought he had behaved badly toward anyone, and he was quite put about if anyone suggested otherwise. But rather bizarrely, he was quick to complain when anyone took advantage of him in a deal. In fact, so proud was Daniel about all of his accomplishments that he wrote a manuscript of all his adventures. However, he died before it could be completed. It was published posthumously by his friend Buck White and is still available to read, titled The Book of Daniel Drew. Anyway, this was quite a long episode today, but I hope you enjoyed it. Until next time, thank you for watching.